Our next guest says he is cautiously optimistic with the outlook. Joining us now is RBC's Gerard Cassidy. He covers the banks for a living. Gerard, I got to say, the financials have been a call for a lot of folks for a long time, and they just haven't really worked out for a long time. So why are you optimistic about the banks? What's changed in your mind?
Dom, I think what you're going to see is that the bank stocks should do pretty well once the Fed reaches its terminal rate for the Fed funds rate. If you go back to the last four tightening cycles, including the 1994-95 cycle, and you'll notice that the banks do quite well once the Fed reaches its terminal rate for Fed funds. And if the markets are accurate, they're calling for a terminal rate sometime in the spring of 2023, between 5 and 5.5%. I'd also point out that the banks were doing really well from June or July 1st through about 3 or 4 weeks ago, and they outperformed the market. But since, to your point, the last 3 or 4 weeks have been really rough for the banks.
So, Gerard, there was a point in time when people used to look at the steepness of the yield curve as a way to kind of gauge whether or not the banks would be, generally speaking, healthy. Meaning if higher rates were higher and low and shorter duration rates were lower, that meant that the spread that they could make was bigger, and that was a good thing. It's been inverted deeply so for a while now. So what has to happen? Does the yield curve need to uninvert, basically, before we can get the banks a tailwind?
No, that's a good point, Dom. I would suggest that the banks, when you look at the sensitivity to interest rates, they're far more sensitive to the front end of the curve than the long end of the curve. Now, granted, of course, when they make commercial real estate mortgages, it's off of the 5 or the 10-year, of course. Auto loans sometimes are off, the 5 or 7 year. But most of the lending is done off the front end of the curve. And so banks will tell you that when they see rates go higher, 75% of the benefit of rising rates comes from that front end of the curve. So the yield curve itself, yes, we'd like it to be steeper, but it's more important that front end of the curve stays high. So if the Fed raises rates, let's again say 5.25%, and they stop, and they don't move on rates for 12 to 18 months, well, then you're really going to see the banks do quite well because the margins are going to hang in there like they've done in the past.
Is there going to be any kind of a mean reversion, Gerard, in your mind with regard to bank valuations? Right now, despite the underperformance, J.P. Morgan still trades at a hefty premium on a price-to-book value basis versus, say, Bank of America or Citi, other of those money center type banks. Are you playing for better times ahead for BAC or Citigroup or regional banks versus J.P. Morgan?
Yep. I would say the regional banks may be the better place to be initially because everything is going to really be focused on what I call the right side of the balance sheet. It's been 15 years, Dom, that anyone's really had to focus on deposits and deposit costs because, as you know, since the financial crisis, the cost of funding has been 0 to 25 basis points, with the exception of 2018. Well, if we get a Fed funds rate of 5%, wholesale funding costs are going to be quite expensive. Therefore, banks with concentrations of consumer deposits, even though those deposit rates will move higher, they're still going to be considerably less than wholesale funding. So banks like Bank of America or some of the regional banks like a Key Corp or Fifth Third, these companies have considerable amounts of consumer deposits, which will benefit in an elevated rate environment, which is likely what we're going to see for most of 2023.
And Gerard, before we let you go, we know there's a lot of talk of recession. Even Jamie Dimon at J.P. Morgan himself is bracing for what could be a big recession in the coming year. Are banks okay if a recession comes?
That is the $64,000 question. It's a very good one, and it really comes down to the severity of the downturn. If you think it's an 08-09 recession as a bank investor, that's the severity of this one, then don't own a bank stock. On the other hand, if it's a mild recession like 01, then you can own bank stocks because their revenue growth from the net interest income that they're generating, even with a stable interest rate environment, will more than cover the cost of higher credit. So we would say it's really going to come down to the deepness and or shallowness of the recession. A shallow recession, the banks will do well.
All right. Gerard Cassidy at RBC Capital Markets.